Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. Joining me on the desk this afternoon, we have Chris Dearborn and Maddie Radner on Nasdaq's market intelligence desk, as well as Steve Sosnick, chief strategist at Interactive Brokers. And we're here to talk about the new pain trade in the market. And Steve, I religiously read your note. I'm probably one of your most loyal readers, and you brought up a great point. The whipsaw, not even just a couple days, a couple weeks. Sometimes these trades would take months to play out, taking place in a session.
It's amazing, right? I mean, we opened 2 weeks ago Monday, just looking like the world was going to go to hell in a handbasket. You had people screaming on TV for emergency rate cuts. We were diving into a recession. Well, if nothing else, traders learned a valuable lesson, and that's, be ready to buy dips. I think it may have gotten a little mechanical of just we'll buy any dip anytime, anywhere, but that was the result of some temporary trades converging and coming to a head at that point. But the other thing investors have learned is let's the trend is your friend. So as soon as the rally became changed from a buy the dip event to a positive momentum event, they went back to that part of the trade too, and I think we may have gone a little far in the other direction in terms of chasing the rally.
But how quickly? These moves used to take quite some time, and now you have traders caught in the pain phase here, where how many more days can we continue to go up on what fundamentally not much has changed? But then on the flip side, if you were looking, it felt like a pressure valve was almost released.
Yes.
If you were looking for some relief in these highly valued names, it happened.
Well, that's it. If enough people are waiting around to buy a stock or a market at a certain price, I'll buy it if there's a 5% pullback. Well, that's what's going on, is they bought at that 5% pullback. But what's troubling me a little bit is not necessarily quite so much how the momentum has turned. It's certainly, we went from, be greedy when others are fearful, so now I'm becoming fearful when others are greedy. And the issue I have there is, we're somehow trying to thread this needle of solid economy while at the same time aggressive rate cuts. And to me, I don't know that we're going to get both, and we're going to find out on Friday if the second part of that is going to come true. And I do question whether Chairman Powell is going to be quite so eager to accommodate the market's rate cut expectations.
Right, and Chris, to Steve's point, if we were to have gotten that emergency rate cut, to me that would have been the surprise. Right,
We've seen that before.
And there's nothing that bad with the economy that requires it.
No, the inflation data that we got last week, the retail sales that we got last week, all play into the cooling labor market, softer inflation, soft landing mantra that they've been talking about ad nauseum for years, yes. Right? We've been at a 5.25-ish rate for a year, July of 2023, right?
Yes.
Right?
Yeah.
And people have been talking, we've been talking, and a little concerned is that they were late to raise rates. People are concerned that now they're late to cut. And everyone's, hindsight as a Monday morning quarterback, but the data is supportive, and almost everybody's on board. A couple of the hawkers, one of them spoke today up in Alaska, and she said that it's very patience still is needed. But I think, and the market is buying, that's going to 100% chance of a cut, whether it's a 50, which is about 25-30%, or a quarter, which is about 70-75% happens September. It doesn't make a difference if the cut was July meeting or at the September meeting. A quarter point doesn't make a difference. It's the signaling that comes with it. And to your point, Steve, on Friday in Jackson Hole, we want to see what his plan is, if he's even going to outline it.
Exactly.
He was very forthcoming during the press conference. It's about as signaling as you possibly get that they were going to cut here in September. So let's see if he gives more signaling, that the markets are all eyes on that.
Yeah, and Maddie, nothing fundamentally has changed, according to Chris and Steve. Nothing.
Yeah, I mean, the market is just whipsawing back and forth based on kind of every data point that's coming out. When we look at small caps, they were actually down almost 10% just over the first 3 days of the month. That's very significant. They are underperforming again this month. But in terms of when we look at the quarter, they're actually outperforming the S&P 500. So they're slowly gaining those losses back from the first 3 days of the session.
I think, and we spoke about this with Steve Wyatt, right, from BOK
Yes.
Financial, that some of the indicators moving into that vol drop and then pop, that vol spike and then drop and then market back up again, was the disparity in small cap performance relative to the rest of the market. It was the velocity of that prior to that move. That was distinctive to me.
And I think when we look at some of the sectors within the small cap space, and even larger cap space, it's really those rate sensitive sectors that are actually performing pretty well over the recent weeks, such as financials, real estate, and utilities, where some of the ones more data dependent are kind of still underperforming the market.
I also think the selling the vol is another influencing factor on what we saw as well. And they were selling when levels were quite low too.
Yeah, well, that's one of the reasons why we had the VIX spike, was what we had gotten to a point where we were seeing record low amounts of correlation in the market and near record high amounts of dispersion, which they're related but not the same thing. And the point behind that is, if you have low correlation and some of the stocks go up, some of the stocks go down, the index is relatively unchanged. Well, as the carry trade imploded on Monday morning, people needed volatility protection, and they needed it in a hurry. Right. And that drove VIX up, and that then squeezed out all the people who were doing the so-called dispersion trade, saying index volatility is going to remain low while single stock volatility is going to remain high. So you sort of pinwheeled two trades on top of another, and that's how we got that big blow up. And maybe that's why it passed so quickly, because it was such a weird, abrupt blow up.
It was unwound.
It was unwound.
They unwound that real quick.
Although right? I think they're rewinding it to some extent pretty quickly.
I think so too. You had a 77% drop from the 65 to 15, or vice versa, going up, and on the VIX. And the issue with that was exactly what you said. You can talk about the yen being part of that carry trade that kind of played into it as well. But really, it was a 3-day slide into the indexes across the board. And when you look at I wouldn't call it a rally, but it is. I think it's more of a relief rally with the buy the dip and then the continuation of that. If you look at the S&P 500, over 470 companies are positive since the 7th when we started to rally. The Russell, to Maddie's point, to a point, is you've got almost 1,600 companies in the Russell that are positive for that same period. So you're seeing a lot of companies participate, just like you saw a lot of more companies in the breadth of the market participate in the July rally as well. So you're seeing people buy the dip, you're seeing that kind of rally up a little bit, but when you're looking at synthetics and unwinding a very tight trade, I mean, you're paying vol between a 14.5 and a 16 on the VIX, and you're looking at the S&P puts. When you do that, it's kind of tough to bet against that until it happens.
The problem I have here is you've got, thinking of how these volatility indices are constructed, none of them are fear gauges. I know that's a popular term, but none of them are constructed that way. So VIX being the popular measure is the 30-day, it's meant to measure the 30-day, the volatility, market's best estimate of volatility over the coming 30 days. Think of what we have over the coming 30 days. We've got Powell on Friday. We've got NVIDIA next Wednesday, which will ratify or unratify a huge portion of the AI trade. And by the way, volatility does count on the upside. It's agnostic. You have jobs report on first Friday, what is it, September 6th. You have CPI and PPI the following week. And guess what's 30 days from yesterday? The next FOMC meeting. So somehow the market's decided, we're fine, nothing to worry about here. It's end of summer. We're not going to see anything for 30 days. That's a bit much. And that plays into your point of just let's go crazy for volatility. All right, we didn't need that, but now what are you hoping to gain here? You're hoping to squeak out, if you're shorting it down here, you're hoping to squeak out a point or two, right, with the risk of 5 to 10 in the other direction or more. Seems like a bad risk reward to me.
It does. I agree 100%. There's more risk than there is reward on that. Yeah. But again, the problem comes down to where you're going to put your money. So if you're playing that game and you're hedging your bet, how else are you going to hedge it? You're going to hedge it with puts on the individual, on the underlying, to some, but you have to play the larger indexes and the different vol indexes, whether you're playing one off of one of the smaller indices or if the S&P is where you have to be because of the liquidity that's in that index.
Agreed, but no one's yet really doing it.
It just seems to me no one was taking advantage of cheap fall, right?
Well, that's it. People were more willing to sell it than buy it.
Lower levels of VIX, Vixen, whatever so you're using, to me, That's, not that it's the fear indexes, but to me, it's a little bit scary when you have so many people in a crowded position and they're not taking advantage of the cheaper trade.
Agreed. The only thing I will say here is, I think because NVIDIA earnings, I think market is reacting a little to NVIDIA earnings, so you are getting a fairly large spread between Vixen over VIX, which is starting to, I do think that reflects, because NVIDIA earnings, whether you like it or not, are not just going to affect NVIDIA. They're going to affect AMD, they're going to affect ARM, they're going to affect a whole, they could spill over into, Microsoft and Alphabet for that matter, depending on how they say spending on AI is going. So I think that's a premium that I think is reasonable. I think it's fair.
And then you also have to question as well, to your point earlier, Chris, that these stocks are performing well, right? 1,600 of the Russell 2000 is up. Are those multiples justified? Was earnings season that good?
No, people are buying the Russell and the small caps because the expectation of rate cuts coming and the cost of capital is going to be significantly cheaper for these smaller cap companies that need to raise money over the next 12 to 24 months. That's why people are buying the Russell, and they buy it on a dip.
Yeah, I think the only thing to point out is there were a lot of eyes on the remaining 493 companies outside of the Mag 7 this earnings season. They are expected to see positive year-over-year earnings growth for the first time. So I think that is something that is standing out to people. Kind of that disparity is getting a little bit narrower between the Mag 7 and the rest of
but the whole thing is it's guidance,
Yeah.
right? If you, I feel like if you miss on guidance,
Right.
you're getting crushed. But if you do beat well on guidance, it's not doing as much as it is in terms of that selling pressure. But another risk area of the market, if you will, Maddie, anything that you're seeing, whether it's IPOs or secondaries, that can signal perhaps what the next quarter or two may look like with bringing new companies to market?
Yeah, I think the second to last week in July was really where we saw a lot of companies come to market. Lineage raised over $4.4 billion in proceeds. Now we're seeing a little bit of a slowdown, and expectations for 2025 continue to be really strong. But I think just as all the other catalysts are coming to fruition, I think there's just a lot less focus and drive for companies to come to market this year. So a lot are deciding to stay on the sidelines. That said, we're seeing a pickup in M&A activity, which could also mean the path to going public will come after that. So there's a lot of moving parts, but I think we'll really see a pickup in IPOs next year.
I mean, even in the primary markets, it's the secondaries that are seeing the most activity.
To that point, we had over almost 30 companies go public since the first week of July on Nasdaq to the last week in August, which is a phenomenal boon for an early to mid-summer trend. And a lot of those companies were large, but the majority of them are small and smaller sized companies. But a lot of them, for the most part, have a path to profitability.
And that's important.
And that's an important thing. Investors are discerning now between where they're going to put their money. It's not growth at any cost like it was in 2021 when you saw over 700 companies come to life. And a lot of those companies, unfortunately, are struggling now in this part of their life cycle. So people are being very discerning of where they're going to invest in that IPO market. We'll get a little bit of slowdown now here for the last couple of weeks in August, and definitely through the early part of September when the bankers start to come back to work after the mandatory 2 weeks, which we don't get. And, and then we'll see what the election cycle comes. But we expect that the end of the year is going to be relatively strong. The pipeline's good. Companies are ready to go. Whether or not people are going to invest, that's up to them. And if you can still get 4% on a 2-year, even in December, so say they only do 3 cuts, it's not so bad.
Well, I mean, Steve, even too, once we're trying to discern what policy is going to look like, I'm sure companies are thinking about, their capital situation, and they don't even know what the, FTC environment could look like, or, how bigger deals could be impacted. So I would imagine there's going to be, some people sitting on the fence as well.
Oh, I think right now it's definitely a tricky time, and I think it's very interesting to me. The fact that people are still so willing to buy big cap companies, yet not really extend into IPOs, tells you a lot. Tells you a lot about what people want right now. As Maddie said before, they want interest rate sensitivity. We'll find out in a few days whether that's the right thing to be seeking right now. And they want, but they want that steady profitability. This is why it's tricky for a lot of the smaller cap companies in the Russell 2000, so to speak, or let's say the others in the Nasdaq Composite that are not the big names, is they do need a path to profitability, and it's not clear to me that just 2 or 3 or 4 rate cuts is going to provide that path, because I think the capital markets, at least the lending markets, have not been closed completely to them. But I think it's more a matter of less a matter of interest rates, more a matter of ability to show that you can pay back your loans or show growth to shareholders.
Yeah, we had a European panel on yesterday with asset managers, and rather than thinking about what the growth companies are within the U.S. market, it was all about margin trends, pressure because of stickier inflation, how that could impact the consumer. They want companies with pricing power that could protect their margins, have a little bit of cushion through a more volatile market environment if inflation remains high, regardless of what's happening with interest rates. And that is how global asset managers are perceiving what's happening in stocks. I feel, some investors perhaps could have been burned when IPOs are more of a liquidity event than anything else. And, a lot of those companies haven't seen their IPO price since the day they went public. And I think investors,
If that.
Yeah.
right. So, and that's how they're looking at, existing companies that are on the exchange as well.
I agree.
Yeah.
But to that point, when you're looking at investing in a new company, you're not in it for the liquidity day. You're in it for a longer haul.
Right.
And you're in it for either fruition or until your pain point is reached on your stop loss for that level. And that's a decision investors have to make, knowing that is a possibility going into an initial public offering.
And to Maddie's point about being more discerning and for a longer term investor, I think that's the right formula, and we'll leave it at that. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.